Okay, we are going to do in class chapter 1, question 5. A partially completed schedule of the company's total and per unit costs over the relevant range of 30,000 to 50,000 units produced and sold annually is given below. Complete the schedule of the company's total and unit costs. Well, this is a different way than we've seen it before. However, we have all the information we need. So, units produced and sold, fixed costs, right? So, we should maybe fill fixed costs in first right away because we know if they're fixed, they're not going to change depending on how many units we sell. So, we'll just put 300,000 in each of those. And then we'll also fill it out over here on Excel. I'm just going to copy and paste that amount. So the other thing they give us is variable costs. So can we figure out the variable cost per unit if we know how many units and we have the total variable costs? Yes, we can. So we are going to take our variable costs and divide it by the total number of units produced and sold. So our variable cost per unit at 30,000 is going to be $6 per unit. So does variable cost per unit change depending on how many units we produce? No. So we're going to keep those as 6 down here. But what do we know? We know that we can figure out our total variable costs for the other units produced and sold. So we have 40,000, so we'll take our 40,000 units times our $6, which is going to be our variable cost. Nope. Let's see. We have a circular reference, so this means that it's a function of itself. So what we should have done was put 6 here so that it then becomes a new formula, right? So just to recap, we're taking 40,000 units times our variable cost per unit, which is $6, and it doesn't change. So then we're going to use that same formula to calculate what our variable cost per unit would be at 50,000. So if you want to see the formula, it's 50,000 units times $6 per unit. So we'll plug that in here. Okay, but does fixed cost change on a per unit basis? Yes, it does. So we know our fixed cost is going to be 300,000 always, right? But divided by total number of units. So our fixed cost per unit at 30,000 is going to be $10 per unit. At 40,000, $7.50, and at 50,000, $6 per unit. So let's put that in here, and it'll do the math for us. Right. So I think this is right, but let's just double check because we have unlimited check my work options. And fantastic. This answer is complete and correct. We'll close out of that. So what's the second part? Assume that the company produces and sells 45,000 units during the year at a selling price of $16 per unit. Prepare a contribution format income statement. So we know both income statements start with sales, right? So we'll do sales. And in this case, it's going to be 45,000 units times $16 per unit. So should be $720,000 in sales. Right, enough zeros? Yes. So the next thing we do in our contribution format income statement is record our variable expenses. Do our variable expenses change depending on how many units we sell? No, it's always going to be $6 per unit. So we'll do 45,000 units again times 6. So that'll give us $270,000 in variable expenses. We will put that in our answer key here. And then what's next? If this is a contribution format income statement, we're going to have the contribution margin, and it's just our sales less our variable expenses, so $450,000. Right? So then what's the next thing we're going to do? We're going to put our fixed costs, fixed expense. And does it change? No, it's still going to be our same $300,000. Then we're going to have our net operating income, right? So our $450,000 minus $300,000, which is our fixed costs. And it's going to give us $150,000. So we can go in and check our work and see if we've done this correctly. And it looks like we have, so we can move on. All right, so we will score this question and we will go on to in class number 6. The Alpine House is a large retailer of snow skis. The company assembled the information shown below for the quarter ended March 31. So we have total sales revenue, selling price per pair of skis, we have our variable expenses, fixed expenses, in beginning merchandise inventory, ending merchandise inventory, and merchandise purchases. So we know from the examples we've done before that we're going to need this information to figure out what? Cost of goods sold. Okay? So I have it set up here, but the one thing that they didn't tell us is how many pairs of skis were sold. So just did a little math. We took our total sales revenue of $150,000 and then divided by our selling price per pair of skis, and we get 200. So we sold 200 pairs of skis in this example. Okay, so we will start out with sales. We know it's $150,000 because that's given. Then what's the next thing we're going to have? We're going to have cost of goods sold. But this is where we need to do our inventory roll forward. So we have our beginning balance, which is $30,000. We know how much merchandise we purchased during the period, which is $100,000. And then we know our ending inventory balance. So we are going to just take the sum of those. $90,000. So our cost of goods sold is going to be $90,000. So then what are we going to have next? Are we going to have our contribution margin? No, we're going to have gross margin because this is a traditional income statement. We'll fill this in here, $150,000. We know our cost of goods sold was $90,000. And our gross margin is $150,000 minus $90,000. So our gross margin is going to be $60,000. Selling and administrative expenses. So we have both variable and fixed of each. So we will put our administrative expenses and then we'll put our selling expenses. And we remember from the previous example that we're going to need to add these two together. So we know our fixed selling expenses is going to be $20,000 and our fixed administrative expenses are going to be $20,000. But because this is a traditional income statement, we're going to have to add in our variable costs, which is why we needed to figure out how many pairs of skis we sold. So now we can take the number of skis that we sold times our variable selling expense per pair of skis. For both selling and administrative. So 200 pairs of skis times our variable administrative expense per pair is $2,000. So if we add these two together, do it over here, equals the sum of these two numbers, right? And this equals the sum of the administrative expenses, okay? So administrative expenses, $22,000. And our selling expenses are going to be $30,000. So are we going to have net income or net loss? 60,000 less 52,000. We should have net operating income of 8. Just do our formula so we have it. Equals gross margin minus the sum of the expenses. So our net operating income should be $8,000. And what are we going to do? Just so we can check this before moving on, let's check our work. And our answer is complete and correct. So we will move on to our contribution format income statement. So we start the same way, right? So we start with sales. And our sales aren't going to change, so it's still going to be $150,000 as given. But what are we going to break out? We're going to have variable expenses. We're always going to start with cost of goods sold. We're also going to have our administrative expenses because we know there's a variable component to that. And then we're going to have our selling expenses. So our cost of goods sold we calculated from our contribution margin. From our traditional format income statement. And so it's going to be the same number, so 90,000. And our variable administrative expenses are going to be here, 2,000. We've already calculated that. And then we have our variable selling expenses, which we know are 10,000. So what are we going to have here? Is it going to be gross margin or contribution margin? It's a contribution format income statement, so it's going to be contribution margin. So we can take our 150,000 minus 102,000, which is going to give us 48,000. So then we're going to add in our fixed expenses. So both administrative and selling expenses. So our fixed administrative expenses were given and it's 20,000. And our fixed selling expenses were given and it's 20,000. So we have our net operating income again. So 48,000 minus 40,000 gives us the same number. So these two numbers should be the same. It's just a different way of looking at the information. So let's see what number 3 asks. So let's check our work first. Make sure we put all those numbers in correctly. We did. Excellent. So what's the contribution towards fixed expenses and profits for each pair of skis sold during the quarter? What's the contribution toward fixed expenses and profits for each pair of skis sold during the quarter? How are we going to figure that one out? So we know that we had 48,000 in contribution margin, right? So if we take our contribution margin of 48,000 and divide it by 200, which was our pair of skis, we should get $240. So we know our contribution margin and we know how many skis we sold was 200. So let's just check our work and see if we got the right number there. And we did. So we are going to close out of that. We're going to score this question. And that should be everything you need to know for the in-class exercises.